let me do this now. All right. Hello. All right. All right. Now we're going to be on week number 2. And we're the invitation is over in the announcements section it's over in the announcements section of Canvas, and you'll need to look to see, you'll see it in there.
Let me see what you went over tonight.
Did you find it?
Where is it? And I was like, you mean my Bible? And then she like took it and she was like, yeah, well, a lot of people were really uncomfortable tonight, so I just need to look over this and see like what it is. And I was like, oh, well, okay.
All right. Did you find it? Okay. The invitation is going to be in, let's see, yeah. BISS 1123 screencast part 1, 96818. Do you see that? It'll say BISS 1123 screencast part 1, 9618. Find it? Everybody else online now in the room found it? Yes? Did you get
Well, so
Like, should I tell her that I hurt my feelings?
It's
All
on the
day.
sheet then. How? I don't see it. You're viewing. He's just on the. Okay, so. So the. Yeah, but just make sure it's clean. Interesting. Let's see here.
Okay. Okay. See you on Friday. But what you do then is go back, and I have all the assignments laid out that we're shooting list. Send them in there. So the assignments. And set up something for you. Okay. But in order for me to do it, I have to have a list. So you'll get here. In there? Okay. All righty. Now let's go down here real quickly, and we're going to go to the module, and to the modules, and of course we're in module 3 or 2. There's one. Okay, this is week 2. I apologize. Now let me start with the XLS3. But that's the Guardian Payroll Roofing. You remember we did that very, very complete, and you should have uploaded that already. As you'll note, I'm working ahead in terms of cases. And the reason I'm doing that is so that at the end of the course, when you have some projects and you have the finals, I give you some slack time to work so you can concentrate on those things. And we'll talk about that when we get over there. Now, we have some other cases that are up here, and someone asked me about the, I assume you're talking about the standard deviation function in Excel. Is that correct? No? On the quiz. Are you talking about for the financial ratios quiz? Okay, which quiz?
It says assume that an average investment pays off $10,000 with a standard deviation of $450. If investment returns are distributed normally, the percentage of investments that will pay off somewhere between $9,550 and $10,450 is approximately A, 99%, A, 99%, B, 68%, C, 66%, or D, 65%.
It should be 66%.
Well, that was wrong.
Well, you're going to have, in terms of, and which quiz is this?
You text chapter 2 through chapter 4.
Okay, let me pop over there. Now, all right, if the average is, if the mean, let me go over here to the items. Okay. If I didn't screen them on, we'll see. Okay, the average investment pays off $10,000. That's the mean. Okay, the standard deviation is $450. Now, one standard deviation above the mean is going to be $10,450. Okay, and then one standard deviation below the mean is going to be $9,550. Now, between those parameters, you're going to have, you should roughly have 66% of all of the observations. Now, just to check ourselves, let's go out here and we'll look at the standard curve, or the area of the standard curve, because that's what that question is really all about. Okay. And this is Wikipedia, is about as good. Yeah, we'll go find something else a little bit more correct. Here we go. Okay. And the standard curve, and let's find it over here. Well, they're not going to let's find it here. All right, standard curve. This curve. Let's go to Math Bench. Take a look at it. And wait a minute here. Let me look at this. Yeah, it's going to be 66%. Oh, it asked for, and what did it give? 68%. Okay. Shoot me an email. Let me know about that, because I'll just go ahead and I'll change it.
I also had a question about questions 34 and 35.
Okay, let's look at them.
It didn't seem like it made sense.
Okay. I want to check the standard deviation thing for just a minute. Now, I'm over here and taking a look at the areas under a standard curve, all right? And, well, they're going to give us a video. Let's sit through that. But what I was asking for were the areas under a normal distribution. Oh, let's look at this, all right? This will help us, I think. Now, if you'll see here, and I'm over here at this site, gosh, who are these people? If they give us the areas under the normal distribution, okay, and they give us, here's a situation where it has a mean of 50 and a standard deviation of 10. So one standard deviation above is going to be 60, one standard deviation below is going to be 40. And the percentage of those that will be, and they're showing you this here, between 40 and 60 is 68% of the distribution. Now, if somebody puts 66, shoot me an email, okay? And I'll grant you credit for the simple reason that the 68 is a rounded figure. Fair enough? Because the 14, when you have between the mean and the standard and the first standard deviation, okay, you're talking about 14 some odd percent, and people will round that off, and so it's 68%. It's 2/3, a little over 2/3 of all of them. So if you put 68, but you got 66, send me an email, and I'll change your score for that. Okay. Now, yes. Which question? Okay, you're still talking about the quiz, right? And what item are you talking about?
He's asking if it's equal 68.
No.
I also had a question about 34 and 35.
Okay.
They just didn't seem like they made sense.
So 34 and 35. 34. Which of the following does not measure the center of a set of data? Now, the mean, the average does. The median, it's the median, it's the middle. The maximum does not, and neither does the mode, okay? So if you chose either one of the two of those, you should have gotten credit. If you only got a half credit or no credit, send me an email about that, because and I think what I did when I created that item, I forgot to take out one of the two others. Follow me? Because there are two correct answers there and two incorrect, and there should be one incorrect. Got it? I don't believe I set it up as a multi-answer question where you had to get both the maximum and the mode. The maximum is obvious, that's the largest. The mode is the most frequently occurring, excuse me. So now, technically the correct answer would be maximum and mode, but if I didn't set up to give you credit for either or both, then I'll need to do that and alter your score. Fair enough? Now part of this, and I apologize, is I've had to, when we left Moodle last semester, we had to export all of our stuff, and I've exported some things in here, and probably in my setting them up, I didn't set them up like I should have. So send me an email. Got it? So I can get that corrected. What other question? What else did you have a question about?
35, but it's a similar.
Okay, let's look at it. And which of the following is not a categorical type of data? Okay. Now, the truth is, ordinal is not. Ordinal is like a scale of 1 to 5. That's an ordinal level measurement. Nominal is a categorical type of data. We use names or categories. So those two, they're nominal and categorical, are correct. And then ratio, no, that's incorrect. Okay? So the correct answer for 35 should, and again, it's probably one I didn't set up in the business of importing these and then getting them edited out. Nominal data are also known as categorical data. The terms are used interchangeably because nominal or categorical data are data that delineate a type or a characteristic, and so we can only count it. It occurred one time, 100 or 50. Ordinal is from 1 to 5, and in terms of statistics, it's 5 or 1 to 10, but these signify some kind of range from the lowest to the highest. And then the ratio is the purest form of number, and that's where you have an absolute zero. And in the physical sciences, that would be like the absence of any heat. And they have an absolute zero temperature in the sciences. It's a ratio, and that means, well, really, ratio data have two properties. One, they have an absolute zero. There's none of it. Two, they also have the qualities of an interval type of data, which is equally divisible and that are infinitely and equally divisible. 1, 1/2, 1/4, 1/8, 1/16, 1/2. Okay? So this is another one. Send me an email, let me know, and I'll make that adjustment. The correct answer is actually, there are two of them. Ordinal and ratio are not categorical type of data. The two, and nominal and categorical are the same. How many of you had statistics? Okay, so you understood, you remember, you recall when they talked about levels of measurement or types of data. The highest is ratio. The next highest is interval, which is equally and infinitely divisible. And then the third level of order of data are ordinal data, and then you have the nominal or categorical. Okay? So if you send me those emails, I'll get those adjusted out. I'm having to do this in all my classes. As I was setting up the tests and quizzes, importing and exporting, there's some of these I probably missed. I just simply missed that. Fair enough? So please send me, anybody else have one you've identified? Anybody? Okay. All right, well, we'll proceed there. And if you do find something, let me know. And here's what happens. I go back and I take a look, and then I just simply correct the score. And typically what I'll do is, if those who got, if you had something in there already and it was kind of right, let's feel like this. You won't lose any points, okay? Everybody with me? And I hope all those of you who are out in screencast land are as well. Do we have anybody? I've got 2, or there's a few of us out there. All right. Anything else? Okay, let's go ahead and then we'll move on over down into the module. And again, to keep you logistically in terms of what's going on, and we've talked about this before, the ground-based is this session where we meet, and then over the weekend I'll post a part 2, which will cover the other 75 minutes of instruction, so we have the whole 150 minutes, and I've talked about that before. Now, we're working through these cases, and each of the cases that we work through have a particular business problem, and I have an example for you, okay? And then I have one of the examples from the text where we will work through those, all right? Now, you should have already uploaded the Guardian Payroll, that's XLS3, and you should have uploaded XLS1 and XLS2, and I provided you those keys. Got it? Now, I have to say this for a few times before it really kind of sinks in. When we're in here in class, I'm spending it like workshop time. Very practical. Here's a function, here's a problem, here's a way that we displayed it visually, etc. Because at the end of the course you'll have, and through the course you're going to have hands-on assignments, you're going to have a project or a final exam project where you'll be using these skills. And these are all things you're going to be working with or using with somewhere, some way out in business. So I'm going to be working through these, and if you just try them and upload them, you're good for the credit. Now, because I have it in the screencast, if you really did understand, it's in your best interest to go back and look at the screencast. I have those so that if you want to, you can go back and go, well, I didn't really understand it. As I've said before, if you have a question, you can certainly say, Dr. Harmon, I was looking at looking at the screencast at 1 minute, 1 hour, 18 minutes, blah, blah, blah. I don't get it. And I can go look and pinpoint that, and I can try to answer your question. I can also, once these are loaded up, go through the transcript and answer your question there. So I'm kind of front loading these, but I'm using them as workshops so that and feel free to try them, because you're not going to get counted off if you do. And I'll show you how I would handle it or what I would do with it. Okay? So I want to say that so everybody's clear on that. Now, we're going to come down here to 9.6.18, and we had XLS3, which we've already uploaded. And then you have this quiz, few chapter 2 through 4, excuse me. Now, I want to note that I would like to encourage you to go out and take a look at some of these resources that I've curated for you. What I try to do is to find something that's out in the real world, quote unquote, that provides you an example of or supplements what you've got in terms of classroom and your textbook. And here's, I think, if you had the quiz on financial ratios, and here is an excellent resource. It's a short history on accounting ratios, how they came about, why we use them. And then I also have a Wolfram on the golden ratio. Kind of gives you a little bit of the science that underlies some of this. And then I've got a site over here called Big Charts. I've got a NASDAQ stock comparison chart, and then Google Finance Company, its comparison chart. So some resources for you. You don't get any extra points if you do these. You don't get any points deducted if you don't. They're just things so you can see that are practical examples. And I try to share something with you that I think that's going to be a good example for you, and something that's going to last for quite a while for you in terms of saying, okay, I remember I looked at this resource, etc. Now, on top of that, I want to just take a moment and talk about some sources or resources I think are really good. And one of them is the New York Times. Now, I understand that you'll hear a lot of negative stuff about the New York Times. I understand that. But the New York Times is not filled with all liberal, crazy people. It also has probably, outside of the Wall Street Journal, the best source that you can find in terms of business. If you come over, and now I don't know what I pay for the Times, but you can beam into the site. I think you can look at 10 articles. It's probably not worth your time to buy it, but there are two sections I look at. One is the business section, and the other is the text section. And I especially do Business Day. New York City is the financial capital of the world, and other than the Wall Street Journal, you won't get better coverage than they do here in terms of understanding what's going on in the market, etc. Now, one of the really valuable and I think insightful things that they have there is Andrew Sorkin, The Deal Book. And The Deal Book is basically nothing but his daily ruminations about mergers and acquisitions, what's going on in that arena. And it's about the best source, in many ways the only source you can get. And New York City, because it is the financial capital of the world, is the place where people come, venture capitalists, for example, who come to engineer mergers or acquisitions. So the Deal Book is a great source of information. And you'll see some other types of articles about what's going on in different industries. And so I would encourage you to come over and take a look, because they've got some really good, excellent sources for you to take a look at. Now, I'm going to go up here to the text section. And again, you'll see here's something that's going on in terms of all this business about interference by the Russians. This is this Twitter and their battles with this guy, Alex Jones, and the whole question of privacy and all that. And so you'll want to take a look at all the interesting things they've got going on over here as they give you kind of the skinny on what's going on on the street and just general business trends. Okay? All right. Anybody have a question? I'll stop for a second. Anybody? Okay. We'll go on then. And we're going to go ahead and come down here, and we're going to look at XLS4 today. Okay. And we have, let's see, what do we have here? We have XLS4 and XLS5. I will probably do, depending on how fast I go, I will probably do XLS4 and then do 5 as part 2. Some of the background I'd like you to look at is this resource about budgeting versus forecasting versus projections versus performance. What are the difference of them? The differences. I have some sources here for you about government spending, debt versus deficit, understanding those differences, trade deficits. What are those? Keynesian economics. So some sources to help you put some of this into perspective, because in case 4, we're going to be doing some extrapolating. Let's go down here and we'll look at the cases. We'll look at the resources for the Microsoft Excel cases. All right. And if you look here for a moment, we'll just go ahead and scroll down and you'll see XLS4. And I'm in this little, everybody here at the little file. Now, if you want, you can go ahead and just download this so you can see it better. Okay. And here you'll see the case. And this time we're in case 4. And I'll highlight all of that. Now, in case number 4, we're going to look at formulas and the use of name manager. Again, cell referencing and some financial ratios. Okay. Now, I have an example file for you. It's called Dabney Financial Services, and it's in the welcome module. And then we have a file from the Winston text, okay? And that's the Proforma temp, where we start to look at using a Proforma. And I have the related text material out of your book, okay? And the location of the Winston file. Let's start, first of all, with Dabney Financial Services over in the welcome module. And so let's go up here to the home, pardon me, the announcements, I'm sorry. All right. That's not going to take me where I go. Let's go to the modules. My apologies. All righty. Here it is. There's that welcome module. And open it up. And as you scroll down, we're going to find XLSX4. And this is one from spring 15, that case. And it's a nice example. I've kind of worked on them over time. So let's go ahead and download this, and we'll talk about what this is about. So I want XLS4, not XLS5. Here it is, XLS4 SP15. All right, I'm going to download this spreadsheet and we'll look at it and talk about it some. And this will kind of set the stage for this file that we're going to be working on out of the Winston text. Now, let's show it in the folder. I'm going to diminish my browser and throw it out here on the desktop. Now, this is an old case that deals with, as you can see from the 2008 annual reports, but it doesn't really matter because the principles or the template that we're using is what's important. Plugging in the different data doesn't matter. And that's why one of the things I want you to read is that resource about forecasting versus projection, etc., because the section on pro formas is important. The word pro forma means for the sake of. A pro forma is a management tool that we use to take financial data and try to use them to make a management decision. So we typically take data that the accounting department has created and we pull that and put it into a template. Okay? That's all that a pro forma is. And now what we're going to do is we're going to look at the financial ratios and what we were doing here is we were looking at the income statements of two companies. This Dabney case involved a financial services firm, and they're trying to advise their client on which stock to buy. And one of them is CVS, and the other is Walgreens. And you've heard of both of them, and they're both competitors. So we do some analysis of these firms by using accounting ratios. Ratios scrub the data and take distortions out because of size. I'll give you an example. If OBU tomorrow said, we're going to increase our revenues by 10% in 2019, we're probably talking somewhere, I think, between maybe $5 or $6 and $7 million. Okay? If Google says we're going to increase our sales by 10%, that's a whole lot different. So we use the ratio to wash the data, to take out any distortion so we can compare apples. We can take oranges and apples and turn them into two oranges or to two apples. Ratio data have that capacity because they're the highest order of data. But we start with some information. We start with the income statement. Now, how many of you had an accounting class? Anybody? Accounting, finance class? Okay. When we look at a company's financials, all publicly traded companies in the United States have to report their financial statements on a periodic basis. A financial statement typically consists of two things. One is the income statement, which gives us a picture of a period. It could be a quarter, typically. It could be half a year. It could be a year. It could be 5 years. But the income statement tells us how are we doing in terms of generating income in the company. Then we see there's a different type. There's another financial that's called the balance sheet. The balance sheet's going to have our assets, which will be long-term and current assets. And the difference is this: a current asset is an asset that can be used up within 1 year. A long-term asset, also known as a fixed asset, is something that lasts longer than a year. Now, you'll notice that, for example, we have cash and equivalent. I'm just looking right here. Short-term investments, net receivables, okay, deferred taxes, we have inventory, and those are the current assets. Then we have these other, like the net property and equipment, goodwill, intangibles, and other assets, and we get the total assets. This is all based on the accounting equation where assets equal liabilities plus owner's equity. And you'll learn this enough. But what it's really saying is that the assets of the company belong to the people who've invested in the company, i.e. a vendor who extends you trade credit, a property management company that allows you to rent their space. And then it also belongs to the owners, shareholders, partners who've put money in that company. That's an asset. I'm certain that Dr. Flynn, if you take accounting with him or you take accounting with Mr. Nixon, both of them are going to say that the accounting equation, A equal L plus OE, has a moral quality. So what do you mean? What we mean is this, is the asset is owned by people who've put money in the company, who've made an investment. All right? It may or may not be employees unless there's a stock plan. It may or may not be managers unless they have a stock plan of some sort. And we see more and more, for example, in large companies, and you hear a lot of people complaining about it, that CEOs of large companies today get paid in stock. Why do they get paid in stock? It's pretty simple. If they're paid in stock, or they get a cash payout, and to keep their taxes low, they get paid a salary, but then they have a deferred payment in the form of stocks. So if I've got a 5-year deal and I'm running a company, okay, and I have I'm going to make $10 million, $2 million a year, okay? So I'm making about as much money running a big corporation as a minor league baseball player, but hey, you know, the world's not fair. But if I have $50 million out there in stock, okay, and I get that plus how it's accrued, it's in my interest to make sure that stock price goes up. And if you want to see a good example of that, if you go next time you go to Walmart and you go back through the customer service area, they will probably somewhere they'll have today's stock price, because they have employees who get stock options or bonuses, and then they'll say it's up to you to keep that price. So it's in my best interest to make sure the price of the stock goes up. Okay? Because I can collect a big payday. This is to make the manager have an owner's perspective. It was only by the early 20th century that we had people called managers. Before, you owned the company. You owned you're the butcher, the baker, the candlestick maker. You owned a mine. You had a farm. You didn't have people running that stuff for you. You did it yourself. But as things got complex and larger, you started hiring professional managers. And with the professional manager comes a morality problem, a moral hazard question. You say, what are you talking about? The moral hazard is this. A manager says, all right, in 5 years, I'm going to get a big payday in terms of the stock, and my goal is to get the stock price up. I know if I show higher profits, the stock price will probably go up. But while I'm doing that, I may be cutting research and development money or money to pay employees. So I have a moral hazard. To get my payday, I may have to do some things that in the long run hurt the company. So that's the issue that we have. And during the financial crisis of 2008, the Federal Reserve of the United States, which is the bank of last resort, they had that very question of moral hazard. And it was framed in the phrase, and you guys don't remember this, you were young people, 8 or 9, maybe 10. It was called too big to fail. And so you had Morgan Stanley and all these firms on Wall Street that had traded in derivatives, which are funky, really financial products, and all the bad mortgage notes they wrote. And suddenly they started collapsing, and the federal government stepped in. Bush started it, and then as he left office, Obama carried through with it, and that was the bailouts, as you probably have heard, of these banks. But they were called too big to fail because if they went under, the economy goes under. So there's an issue of moral hazard. Well, we got the balance sheet, so we got current assets, and then we have the long-term assets, and then we have the total assets. Now, we have some liabilities, and notice they're divided out by current and long-term. Okay? And you'll see that there. So we have a pro forma. This is a management tool, and this is how we peg and put dollars. So I have the balance sheet, which is a picture of where I'm at that point in time. Now, we end up with this issue of total shareholders' liabilities and equities, okay, for these firms. And away we go. Now, and this needs to be fixed. This should be equal. This should be equal to the total assets plus. So this is going to be different. And this is going to equal total assets. And I'm doing this for, I think this is Walgreen. And this will be total assets plus, and we'll come down to the liabilities. And then we want the owner's equity, okay? And we'll have to go back up here and find, we got the intangible, the other assets, and then we take the shareholders' equity, which is going to be 69. So we're good there. We've got that. And so we should have the owner's shareholders' equity. That's at 68. We got C55, which is the assets. So we want assets plus owners. So the assets are going to equal the total liabilities, and this is for Walgreen, plus the owner equity, and that the owner equity would be the shareholder equity, and there would be. Now these are two companies of different size. You'll note as you come down here, and let's look at for a moment the net income. And they look decidedly different in terms of their size. So in order to compare them, we're going to need to use ratios. This is where the name manager comes in. Now, if you'll do this, click on, let's see, come over here, all right, and let's click on the data tab. And, oh, it must be formulas, I'm sorry. Click Formulas tab. Okay, everybody with me there? And then let's go over and we'll see the name manager. And click on the name manager, and you'll see the following information: the name, and you'll notice here, for example, here's CVS current assets, CVS current liabilities, etc. And then you'll see we have some similar names for Walgreens, WAG. WAG is the stock symbol for Walgreens, and CVS, obviously CVS Pharmacy. But we use the name manager so we can work with variables or names as opposed to cell references. And we talked about that in using them in a formula. Now, when you go to the dialog, when you look at the dialog box, what you're going to see is the name. You'll see a value. You'll see what it refers to. That's the cell reference. Okay? And then the scope. The scope could be the workbook or just this worksheet. And if we want to put a comment in there, we can. I'm going to close this off for a minute, and we'll see how we can use that. All right? And I'm just going to come back over here to this nice little, area we've got, and we can start and we can look at the current ratio. And notice what I've got here. For CVS, its current ratio, that is money that can be liquidated within a year or less, is divided by the current liabilities. We call that the current ratio. And see, if you look there, you'll see in the formula bar where I'm referring to names. Follow me? Yes? That's why we use the name manager. We've talked about that before. If we look at Walgreens, we'll see the same thing there. And the same thing for the quick ratio or the acid test. The quick ratio is where I take the current assets and I subtract inventory. It's also known as the banker's ratio, because bankers typically say, I don't care about what your inventory, I want to know what cash you have on hand. It's a more stringent measure of current assets. And this tells us that I have in terms of assets over inventory, I have about 0.55. So I'm looking pretty good. Now, if I go to Walgreens, here's the same for it. Then we have some other ratios called like the total assets utilization. Notice that we're looking at sales divided by total assets. So each of these ratios is intended to give us a picture of how well the company functions. Now, these so-called current ratios, which start with the current ratio, the quick ratio, and the total assets utilization ratio, those deal with the extent to which we take assets and we convert them into sales. And we would just follow suit with each of these if we want to for Walgreens, but we can see them here. Here's CVS and their total assets and the profit margin. And the PE ratio is the price to earnings. For example, here we see CVS price per share divided by the CVS earnings per share. Think about it for a moment. Let's say you spend $250 for a stock, okay? You buy a piece of stock, you buy a stock, it's 250 bucks. You get 25 bucks back in dividends. Now you hope also that you get an increase in the share price. All financial instruments have two components. One is the value of the underlying asset, and two is any cash flow associated with that asset. If I buy a stock, all right, I expect that the value of the stock will go up. If the stock is also paying a dividend or a return, then I'm getting everything I should get for my investment. So we want to take a look at that and see, what did I pay for a piece of stock, okay? And what are the earnings? What's the ratio between them? And here for CVS, what it's saying is that the price of the stock is 12.83 versus the EPS. Okay? Now, I would like to see typically a lower what? A lower ratio, which means that the denominator under there, is the bottom of that division is getting bigger. So if I buy a stock for $250 and I get $25 in dividends, I've made 10%. If I buy a stock for $250 and at the end of the year the stock is worth $270 and I got $25 in dividends, hey, I'm flying high. One of the things that we watch out there is when we see overvalued stocks, and right now there are a lot of people saying the tech stocks especially are overvalued. People are paying far too much money for them. So this case was about comparing these two companies and saying, okay, based upon this, which firm should I invest in? And so we look at these different ratios, and we do the same thing with Walgreens, and we'd start to compare them, and it would depend a lot on what we think is important. It would depend a lot on our proclivity for risk. So this is a common business problem. In fact, if you do any day trading, if you use E-Trade, and if you do that, or if you're in an index or a mutual fund or anything of the sort, people are making those decisions. I'll give you a very quick example about myself, okay? I'm at the age now where if the stock market goes down terribly, I'm going to lose my shirt. And I don't have the age, I'm not at the age I can start over. All of you can. You may be able to start over 2 or 3 times in your life. I've done it 3 times. The recession of '82, when everything tanked, okay? And then the tech bubble at the end of the '90s, and then in 2008. But in 2008, something had changed. Something had changed with the tech bubble. I had moved my money over into governments, into guaranteed income securities. Why? Because I'm starting to approach retirement, and I can't afford to see my portfolio go up in smoke. So now, in 2007, I came here to work here in 2006, and between 2006 and 2007, I had a lot of students, particularly finance students, who were telling me how stupid I was when they hear my spiel about why was I in financial products that were earning me 1% a year. Okay, well, the next year when their financial product their returns were minus 58, I said I'll take 1% any day. But that's also because my risk profile's changed. I'm an old guy. I got white hair. I got wrinkles. I want to live my golden years just like they should be. Doing what, Dr. Harmon? Well, I want to have a strong Wi-Fi connection, a nice tablet, and I want to have a season pass to what's the big buffet where all the old people go eat? What's it called? It's wherever there's one, and I want Golden Corral, I think. So I have a season pass to Golden Corral, a strong Wi-Fi connection, and some good heart medicine. I'm good. I'm living the life. I can run around. I can drive my car. I really enjoy now. What happens is people will get behind me and they'll get really frustrated. And then, in particular, they'll pull around me. And I enjoy it because I'm an old person. I can drive how I want to. I can pull in front of people and they'll stop. I can cut people off. I'm an old guy. I can park over 3 spaces and I get out. I'm an old person. Be nice to me. One of my father's proudest days was the day he got his handicap sticker. He had heart problems, and so he got a handicap sticker, and he requested, this is weird, he requested that we put it in the pocket of his jacket when we laid him to rest. One of his great accomplishments. And he said, this is just like having a limousine. I've got front row access. And when people would park people would park in the handicap zone, he'd go ballistic. Hey, that's mine. I earned that. So I'm hoping. But I get every senior discount I can get. There you, yeah. All I can say is, young folks, listen. If you do anything, please continue to pay into Social Security. It'll be there for you when you're my age. Trust me. You seem a little skeptical. You're kind of quiet. Okay. All righty. Well, you've seen it. We've worked with this pro forma, and this is, again, a sake for the form of, and we collected these data, and we used the ratios to put these into some type of, we used them to put them into some type of sense. And as we look here, we can send the profit margin. This is the net income over sales. How much do I get per sale, etc. So a common business problem is for me to look at a company and use the financial ratios to try to figure out how my company is doing. That's one of the reasons I posted over there a short history of accounting ratios, because there was a time when we didn't use them and didn't understand them or try to use them. Well, I'm going to close this off, okay? And I want to try to get us started on this pro forma temp, and that's going to be in the Excel companion zip. Okay, I've got this, Jewel, and I'm going to go back into the files, and we'll go to the files, and I'm going to get that. And if you're interested, I have also there for you Chapter 12, Figure 12.6, and Figure 12.7 that deal with this issue of a pro forma. And we're going to look at that file, okay? Now, I want to find the file there, and that's going to be in the Excel Companion Content 1 zip file. All righty. I'll find that. And there it is, Excel Companion Content 1 zip. And let's download that. And we'll download it to our desktops. So what I do is I put mine, I'm using Chrome for my browser, and I always show it in the folder. And then I diminish everything. I'm going to diminish this down. And I'll grab this Excel Companion content file. Okay? And I'm going to open this up. And I think it's going to be over in, well, I don't have to think. I know I have the answer. It's going to be in Chapter 12. So we want to go down to Chapter 12. And here it is. And I'm going to get the templates. And I'm going to open it up. Now you'll also note, okay, that there are some solution files, and you're welcome to look at those as well. Here's the pro forma temp, and let's open it up. And you'll want to save this to your desktop, okay? And yeah, and then in addition to that, you're going to want to, you'll want to then, once you've worked through it, boom, pop it back up there. This is the pro forma temp. It's read-only, so I'm going to need to save it on my desktop. And this PC, desktop. And this is a copy of the pro forma temp. And there it is. Now, let's look at this for just a moment. Here we have a whole series of sets of data. At the very top, sales growth data. And there's narrative, there's narrative in the text in chapter 12 that covers what all we're going to be planting in here. And so we've got these different figures that we're going to be working with. And we're going to import them in and use the name manager. Now, I'm going to click on formulas, and I'm going to see if we have anything in the name manager. And we do. We have the cost of goods sold, etc. And so we're going to use a pro forma here. We're going to look at cash and securities. So we're going to basically end up getting, we're going to compute the total assets of this company, and then the current liabilities. And then once we've done that, we're going to look at the income statement. Now, I'm going to close this off for a second. And I'm going to go back up in this Excel file, pardon me, in the file, and I'm going to look in the solution files, and let's open that up. And let's look at chapter 12. All right. So you don't have to put in a whole bunch of data, but you're going to get an example, and I'm going to save this. This is the one I am fine with you uploading. Any questions at this point, what we're doing? Now, again, the verbiage for this is over in chapter 12 of your textbook, and we'll go over there in just a second. Now, I'm going to click on formulas. Let's see if I have a name manager. I don't have any name manager data in there. The practice one did, if you care to input all that data and follow the narrative of the case and input it. But let's look at this file right here, okay? I've got a current price of a stock, and I have a 6-month price. I have a project. I have a profit. And let's hit that here for just a second. And I'll lose $1.50. Now, we're looking at what we make in terms of a call or a put option, okay? And basically, they are what they sound like, a put or a call. If you look at the bottom, profits possible if the stock goes up, use money if the stock goes down. This is what we call a derivative, an options play. And we do good in bear market, bear spread, and buy the call. So the idea is, as they talk about, for example, in bear market, if I have the right to sell it to somebody at 35 bucks and the stock price tanks at 29, I sell it, and the people who have the contract with me have to pay me 35, although it's only worth 29, and maybe I bought it at 30. You follow me? And so we have those values inputted there using the name manager. Now, I've mentioned a couple of times the verbiage over in the narrative over in chapter 12. And let me bring this down for a sec. And we'll go back over here. And I'm going to, let's see, I'll get rid of that. I'm going to pop open my textbooks, and this is Vital Source, the text. And we'll sign in. All righty. And we'll go ahead here to the contents, and we'll go to chapter 12. Right? I think that's the chapter we're in, or where this is from. Let's take a look here for just a second. Okay, and let's pop through here. 12, okay, 02. And I had said that these are going to be, we're going to be using 12.6 and 12.7. So let's go over to figure 12.6. Here's figure 12.6, and here's the full-blown pro forma, okay, with assumptions and a balance sheet. Now, and they give you the verbiage about how to set how this thing is set up, and we're just simply we're just putting them into this pro forma or this template that we have. And we have SG as sales growth. We have the initial sales, interest paid on debt. So we have everything we need to set up the assets and the liabilities statements. All right? And then we can come down and plug those into the income statements. And they'll walk you through each of those steps if you so choose. The reason I provide you these examples, like we just got through with this one of Walgreens and CVS, is that you already have that type of principle in there, but I want to show you out of the text and so let you see in this text what we're dealing with. Now, I'm going to diminish this for just a sec, and I'm going to open this up, and let's do a little bit of exploring. Now notice this is using also a conditional statement. And go into this file that's called copy of 12_12 Excel, okay? And let's look at it for just a second. And we're going to see the profit we'll make. And here is a conditional statement. I wanted to kind of introduce you to those for just a moment. If you'll click on, I'm at cell F7, if you'll click on there, all right, you're going to see the conditional statement. Now I'm going to click on the insert function, and it will explain to us, it should explain to us what we're doing. I'll just do it right here. Let me copy this. And I'm going to put it into a Word document and then size up so you can see. All right. Now, here's what's going on. Here's the English. How many of you have worked with a conditional statement before? Anybody? Okay. They're not as scary as they look. Here's the English of what's happening. Follow me as the cursor. Equal if, this is a conditional statement. Equal if some condition exists, then do X. If not, do Y. And let's look at that. If D7, okay, they're talking about a cell there, is greater than 30, then we take D7 minus 30. And then we subtract it by 2.5. Now, again, we have, if it's greater than 30, then we take it, that D7, and we subtract 30 from it. If it's not, we just have a default number, and we subtract 2.5 from that. That's all it's saying. Now, I want to diminish this down for a second, and I'm going to put in just a simple combination, as a very simple statement. And I'm over here in J8. If, and I'm going to click this up so you can see it. logical test. Here's the dialog box. When you work with these functions, be it a financial statement, like figuring the stock price, or it's a conditional statement, you can use the dialog box that Excel gives you. Okay? And here's the logical test, and that's the if statement. Here's the value if it's true. Here's the value if it's false. So let's go back to that one for a minute, okay? And let's look at this profit in cell, and we'll see is equal if E7, okay? And if we have equal if E7, and then our profits and equal if G7. And walk us through those conditional statements. Now, here's a little bit different critter in terms of a conditional statement. And we use conditional statements in proformas. Let's look at this one. Okay? This one's a little bit different. We're saying equal. All formulas in Excel need to have a sign in front of them. So equal if 1 minus if D7 minus 35, if D7 is greater than 35, okay, then we have D7 minus 35. Otherwise, we have 0. So what we're saying, if D7 is bigger than 35, greater than 30, the value of 35, then we take D7 and we subtract 35 from it. Otherwise, the default value is 0. So I want to kind of get us started a little bit working with conditional statements. And the text will give you some good data information as far as that goes in terms of providing some insights. So I'm going to scroll this down for just a second. And I want to come back over here. And we're in Vital Source, and they're going to show us these proforma statements. Now again, a proforma is a form called for the sake of. And you'll notice we have a whole bunch of assumptions up here. Okay? Sales growth, initial sales, and all of them with a moniker or with an acronym, excuse me. And then we have then we start with the current statement of cash and marketable securities, and then current assets, and then gross fixed assets. That's anything that has a use life of a year or more. And when they say gross, what they mean is we haven't depreciated the stuff. Then we have depreciation, and we have the net fixed asset. So you'll see there, for example, I'm looking at figure 12.6. You'll see I have the current asset, I have the gross fixed assets, and I have the net fixed, and then I take into account depreciation, and I end up with the net fixed assets of 600, and I guess it'd be thousands, and then I have the total assets is going to be the current assets of 150 grand plus the $600 for the plus the 600,000 for the net fixed assets, so I get the total assets. The beauty of laying it out like this and having these all referenced back is that I can change these and consequently change what I've got in here. I can change my assumptions. So, and I can use the name manager to do that. let me show you what I'm talking about just real quickly. I'm going to open up XLS4. Let's see, I don't want that. I want the, let's see, I want the one from Dabney Financial. This is it. And these are both of these. Close this off for a minute. There we go. Now, let's say that I'm interested in changing, okay, or working with the ratios over here I've got the CVS ratios, okay? So I'm going to do that. I'm going to pop myself all over here, and I have the current ratio. Now let me move this up for a second. And this is the current ratio is the current CVS current ratios divided by their current liabilities. I could say, okay, how will my financial picture look? My statement look. If I go ahead and I change that from 8741.9, okay, and that would be my net sales revenues, and I change that to, and I'll take that times 2. I need to put an equal there. And what I'm doing here, well, what am I doing? You're not going to let me out of that. Okay. No, I'll close you off for a second. It froze up on me. Hey. Right. It's not going to let me, I'm going to diminish it down here for a second. I'm going to go back over here. Let's see what's, I'm not sure why it's freezing up on me, but it is. Let me go back up here and take a look. And it's not letting me edit or do anything. That's weird. So I'm probably going to have to close both of them. Let's close this. Okay. And we'll close that off. All right, we're still here. Now, let's see if I can open this baby back up without freezing on me here. Go ahead and open this back up. I'm going to check that we're okay here. All right. There we go. Now, let's say that I assume that the income is going to be twice what I think it will be. And so I equal this times 2, and I'll see how this changes my balance sheet, my price per share, okay, the shares outstanding, the earnings per share, and then my balance sheet, how that's all affected. And you can see how it changes for CVS. I end up with a higher gross income. Now, if I come over here and I look at the profit margin, I'm going to take net income by net income is divided by the sales, okay? And for every sale, how much net income do I generate? And then I'm going to change this back, okay? And you'll see what my profit margin is. Again, we can use these assumptions to work through what we think are possible outcomes or possible futures. And that's why we use a pro forma. It lets us do that. Now, The file 12.7 works through using an income statement. So 12.6 is a balance sheet. 12.7 is an income statement. And notice what we've got below there. You'll see this. They say column D contains information about the current company status during year 0. You have these 4 years and their basic assumption. Okay, sales growth is 2%. Initial sales are 1,000. Interest rate on debt's 10%. Dividend payouts 5% of net income. The tax rate's 53%. They give you this. If you see that bullet point, those bullet points, those are assumptions. So if I've set this up, the pro forma, and I've used the name manager, it's simple. I just come through and I just put in a new value and everything changes. Okay. Now these are going to be a process where I start with a base amount and I add the increments to them, ending up with the year 4 increment. That's all that's going on there. Does anybody have a question I could try to answer for you? Yeah. And if you want, and let me suggest you this, try that and upload it. You've got the solution file there as well, and you can see it. And you also have the solution there in the textbook. So if you want to take an empty file and recreate that and check yourself against it, fine. I'll give you an example. And let's look at figure 12.7. Sales, okay? We start out at our initial value of sales is $1,000. See that? Okay, now I'm in the book and I'm going to come over here in figure 12.7. And I have my initial amount in year 0. And then I'm going to take, and in cell E, I'm going to have $D, okay, because I'm working across the row, and I'm going to have $D times 0.02. Pardon me, times 1.02, and I'll get the 1,020. All right, and then I'm going to take 2% more, and the next year it'll be 1,040. Yeah, you're right. Yes, it would. I'm sorry. It would, in cell E28, it would be D28 times 1.02. I apologize. And then in cell F, it would be $D28 times $F28. Huh? No, the number is a row. Oh, you're right. I'm sorry. My brain freeze. Pardon me. Let's start over. Let's go to cell D28, okay? That's the initial amount is $1,000. We're going to grow 2% a year. So in cell E, I'm going to put equal, okay? D, D $28 times 1.02. Okay? And then I'll just carry that on across. My apologies about that. But you can see it's gonna grow 2% per year. Okay? Now if I have an assumptions area, I'm going to be good to go. So I want you to try that, but please again, make sure you upload a file where you've tried or the solution file for that so that you get the credit for the workshop. But what we've done is we've worked with a pro forma. Now let me finish up with this, and I won't take but just a few more minutes. If you look at figure 12.6, you're going to see the pro forma. You're going to see the top part will be all of the assumptions. Okay. Then down below is where we calculate we do the balance sheet. We're going to take cash and marketable securities. And then we're going to take current assets. and then gross fixed assets, and then the depreciation. And we have them all over here, the depreciation, right? Okay, and the accumulated depreciation, and then we'll start on across. So these would be our starting figures here for year 0, and then we'll come across for 1 through 4 for each of these, and then we end up with the total assets. And notice that we end up eventually where the total assets are equivalent to the equity. We've got the equity, and then we have the liabilities, and that gives us the balance. The total assets are going to equal the 750, and then we're going to get the current. We're going to get the equity and the total liabilities. We'll end up with 750, and then we just extrapolate it across based on this table. Years 1, 2, 3, 4. Everybody see that? And the text walks you through that. If you care to do that, fine. You have the solution file, but the main thing is I want you to see is it doesn't matter what numbers I plug in here in 12.6 or 12.7. What matters is I've created the assumptions area, and then I have the data organized in a template, a performant, if you will. And then I can just simply run those numbers in, whatever they are, for my assumptions and whatever increments or decrements I end up with, and away I go. Thank you so much, everybody. I appreciate you being here. And this is part 1. What I'll do is over the weekend, I'll do a part 2. And have a good weekend, and be careful. It sounds like it's stormy out there, okay? Thank you so very much. Anybody out there that has a question that's not here with me? No one? Okay. Everybody's safe out there. Yes.
So is it ended?
Just about to. You have a question?
Well, it's not regarding today's class.
Oh, okay. Well, hang on.